Okay, so I just passed out a sheet. You've got your journal entries on the front, and then you've got a balance sheet on the back, which we'll look at when we're estimating our uncollectibles. Okay, the following transactions were completed by Bronze Gallery during the current fiscal year, ended December 31st. If you have a journal template, that'd come in handy. But if not, just do it on your notebook paper. The instructions ask you to record, the first thing, to record the January 1st balance of $40,000 in a T account. Okay, because we're going to have to compare our balance when we get done with this to our estimate to see what our adjusting entry will be. Okay, so let's go ahead and create a T account for allowance for doubtful accounts. And is this going to be a debit or a credit balance? What's the normal balance of this allowance, this contra asset account?
It's credit.
Credit? Yep, because it's contra asset. So the balance is going to be a credit balance. Okay, the next thing they ask us to do is journalize the transactions and post to T accounts. The only other, we really don't need to do T accounts for all the accounts, just this one. We're just going to post it to the allowance. There's no need to have all the receivables and the bad debt expense account. So we're just going to have this one that we'll post it to. We'll post our entries to it. Okay, and again, we're using the allowance method, and we know that because we have an allowance account. If we were using direct write-off, we wouldn't even have this account. So we know we're using the allowance method. After that, we're going to determine the net realizable value. That's just the balance of AR minus our allowance. And then number 4, we do some assumptions and estimate that uncollectible amount. So we'll get to that later on. All right, so the first one, on June the 6th, we reinstated the account of Mr. Nettie, which had been written off in the preceding year as uncollectible. He paid $1,945 cash in full payment. So when we reinstate an account, we're basically reversing the write-off from the allowance when we wrote it off in the allowance. We need to put his accounts receivable back on the books. Okay, so to increase accounts receivable, is that a debit or credit? A debit. So that's going to be our debit. Accounts receivable, Mr. Nettie, for $1,945. Okay, our credit is going to be to what? For reversing allowance, okay, because we're reversing the write-off back when we wrote it off. And that's $1,945. Okay, so this is the reinstatement, and this was June 6th. All right, he also paid us some cash. So increase cash with a debit, $1,945, and we're going to credit accounts receivable for him, $1,945. Okay, so we reinstated the account, then turned right around and posted that cash payment to his account. Okay, we need to go to our T account, our allowance for our ledger T account for allowance account, and post this credit of $1,945. And this was June 6th. Remember, we put it back into accounts receivable. We got to put it back into the allowance account. And we can do that because at the end we're going to evaluate it and adjust it. So it's okay for it to sit there until we evaluate it at the end of the period. All right, July 19th. The next month, we wrote off $11,150 balance owed by Rancho Rigging Company, which is bankrupt. So when we write off using the allowance method, we've got to take it out of accounts receivable, and we also take it out of allowance. Okay, so how do we decrease accounts receivable? Okay, decrease accounts receivable, and then we decrease allowance with that debit. Okay, so if you get confused, accounts receivable is pretty easy to remember because it's an asset. You should know that by now. We've learned that since chapter 2. So you should know accounts receivable is decreased with a credit. So if you do that, you can kind of figure out the debit is going to be allowance. And this was Rancho. Okay, we just wrote them off. They went bankrupt. We're saying, well, we're just going to take them off our books because they're not going to pay us. So let's post that to our T account for allowance. That'll be, I hear you. That'll be a debit of $11,150. And that was July 19th. All right, August 13th. We received 35% of the $20,000 balance owed by Centauri Company, a bankrupt business, and wrote off the remainder as uncollectible.
$7,000.
Okay. So they paid us $7,000. And we probably got a letter with the payment that said, look, this is all you're going to get. We're liquidating our assets. We're bankrupt. This is it. So we say, okay, we'll take your $7,000. We'll write off the remaining $13,000. All right, so if we receive cash, we're going to debit cash. And that is 35% of the $20,000. Okay, if you want to make a note of where that came from. Okay, we're writing off the...
That sounds like a lot of missing money.
A lot of missing money. Well, it happens. That's the risk you take by loaning people money. They're not going to pay it. So we're writing this off. So what else do you think we're going to do here?
What do you mean accounts receivable with 7,000?
Okay, it's going to be accounts receivable, but not 7,000.
Oh, for the 20,000.
We're going to do it for the 20.
And then deduct the 13.
Okay, so we know we're going to clear out his account. We're writing it off the total 20,000, but we're collected 7. We're writing off the other 13. What account do you think that 13 goes to? Yep, allowance. We only do bad debt at the end of the month or end of the period when we evaluate, so estimate. So allowance. Will be that 13,000. Okay, so we need to post that debit of 13,000 to the allowance account. And that was August 13th. Okay, September 2nd. Reinstated the account of Cheryl Capers, which had been written off 2 years earlier as uncollectible. Record the receipt of $3,170 in cash in full payment. So, again, we gotta reinstate and then post the cash. So we're gonna do similar to what we did on June 6th. We're gonna reinstate her account. It doesn't matter that it was 2 years ago. That doesn't matter. And it was $31.70. We're gonna credit allowance because we put it back in AR, put it back in allowance, and then we receive the cash, clear her account. Okay, so that wasn't anything new on that entry, similar to the first one, the same as the first one we did. Reinstate, then post the payment. Alright, so we need to post that $31.70 credit to allowance, to our T account for allowance. Okay. Do what now? This is the credit is the positive. The increase side. It's a contra asset. It's the opposite of an asset. But it's still an asset account. But it's one of those few exceptions, you know. We've had contra equity, we had the drawing was contra equity, we had contra asset with the accumulated depreciation. All right, December 31st, wrote off the following accounts as uncollectible. So at the end of the year, we just looked at some of our customers that aren't going to pay, and we just went ahead and wrote them off. Jacoba Company, Garcia Company, Summit Furniture, and Jill.
Just add all those up.
We can do one entry for that. And that's going to be, remember, we're taking them out of AR, we take them out of allowance. And then we're just going to do each accounts receivable and add them up. Each of these credits will clear out their balance. And 1,800. We add all those up and we get 19,090. And this is common for the end of the year. You know, we're about to report our financial statements for the year. Our balance sheet needs to be accurate, an accurate representation of what is owed to us in the accounts receivable account. So this is common to do this at the end of the year. The debit needs to be posted to allowance for $19,090. Okay, any questions on so far? Got one more to do. Based on an analysis of the $960,750 balance in accounts receivable, it was estimated that $42,000 will be uncollectible. Journalize the adjusting entry. All right, you were given a balance sheet. And you can see where that allowance for doubtful accounts has a $40,000 balance. Okay, that was the end of last year. So that's why the first thing we did was post that $40,000 to the T account to show our beginning balance. Okay, so this was left over from last year. That was the beginning balance. And it came from the balance sheet. So we need to add up the credit side, subtract the debit side. And we'll get a balance of $1,875. Now this needs to be $42,000 because they told us that after they analyzed the accounts receivable and whatever method they used, and they said it needs to be $42,000. So we need, what do we need to do to get that to $42,000?
Divide it by 960.
Well, to make this balance 42, we need to credit $40,125. Okay, so that'll get us to the $42,000 balance. So this is the entry we need to do. Okay, credit to allowance for $40,125, and we may end up having to have a debit for this adjusting entry. It just depends on what you've written off, what you've collected. So you have to make it work to be what you need the balance to be. So we're going to debit the expense account, bad debt expense. This is, and we only do this at the end of the year with the allowance method, and credit allowance for doubtful accounts for $40,125. Okay, that puts that bad debt expense on our income statement, and puts the allowance, adjusts it up to $42,000, and that'll show up on our balance sheet. The expense comes out of our net income. Yeah, you do get some relief from that, but okay, the last thing, we've got about 10 minutes left, so we can squeeze this in. Assuming that instead of basing the provision for uncollectible accounts on an analysis of receivables, the adjusting entry had been based on estimated expense of 0.75% of the net sales of $6 million for the year. So they told us it needed to be $42,000. They did an aging schedule apparently and came up with those percentages and multiplied by how much past due. And now we're saying, what if they did sales, percentage of sales, 0.75%? How would we get that? What number would we get for that? They ask us to find bad debt expense for the year, balance and allowance account after adjustment, and the expected NRV. Okay, so 0.75%.
0.0075.
Another way of saying that is 0.0075. Okay. If we multiply that times 6 million. Okay. So we get 45,000 instead of 42, like they got with the aging schedule. It's close, but it's a little bit different. Okay, and this one we don't adjust it. We only do bad debt expense for 45 and allowance for 45. If you look back to the PowerPoint or the notes, when we estimate it based on percentage of sales, that's our entry, this number. With the aging of receivables, we adjust it, like we just did. So this one is we go straight to the entry. We don't have to look at the T account and adjust it. Okay, that adds to the existing balance of 13, whatever we had, or 1875. It adds to that existing balance. Okay, so bad debt expense for the year would be $45,000. The balance in allowance account would be, it'd be that 1875 plus the 45. Okay, so 46,875. If we use the percentage of sales method, that's what our new balance would be. Expected NRV of accounts receivable. Well, they told us back on December 31st that accounts receivable balance was $960,750 minus $46,875, and that would give us $913,875. Okay, this is on total sales. Remember, the $6 million is total sales, but of that, that's owed to us is the $960,000. So to find NRV, net realizable value, we don't subtract it from the $6 million. You take it out of the credit sales or what's due to you, accounts receivable. Okay, so this is NRV. This is what will be on our balance sheet. Okay, it'll say accounts receivable balance $967.50 minus the $46,875 for allowing for uncollectibles, and then we would have the $913,875. All right, any questions on that? That's a really good example. It gives you reinstatements, write-offs, adjusting to the allowance account with the aging of receivables, and then it gives you the percentage of sales method as well.